Good evening and welcome to today's market recap. Let's start with the numbers. The Nasdaq closed at 25,114 points, up 0.89%. The S&P 500 finished at 7,230, up 0.29%. But the Dow Jones Industrial Average lagged behind, closing down 0.31% at 49,499 points. The VIX Volatility Index settled at 16.99. The 10-year Treasury yield held steady at 4.38%. The dollar index was at 98.21, and the offshore yuan traded near 6.83 against the greenback. In commodities, WTI crude oil closed at $101.94 a barrel, while spot gold finished at $4,629 an ounce. So what is the single most important takeaway from today's session? It is a structural rally with extreme internal divergence. This is not a broad-based bull market. This is a new high driven by earnings beats from a handful of mega-cap tech stocks. Capital flows ended up in two extremes. One is the tech giants with strong earnings validation and AI narratives. The other is the energy sector benefiting from geopolitical risks. Everything in between was ignored or even sold off. Let's walk through the global market path today. Asian markets were mostly quiet due to the Labor Day holiday, with thin trading volume and no clear direction set for the rest of the world. European markets saw a 1.4% gain, driven by a positive reaction to falling oil prices and bond yields. But the UK's FTSE 100 index fell, indicating lingering stagflation concerns and divided sentiment. For US stocks, the market opened higher but internal divergence was severe. The Nasdaq and S&P 500 hit new highs driven by Apple's earnings report, while the Dow was under pressure all day and closed in the red. Market sentiment was completely dominated by micro-level corporate earnings. Money chased earnings certainty, predictable revenue growth, and companies with controllable capital expenditures. For AI names with massive capital spending like Nvidia and Microsoft, the market actually showed concern about short-term profit pressure. Now, did we see any new structural signal today? Yes, we did. The signal is extreme divergence, or what some are calling a K-shaped bull market. This is no longer a simple rotation between growth and value. This is a split between the top tech names and everything else. Capital is concentrating into a handful of winner-take-all stocks at an unprecedented pace. The strongest sectors today were two. First, earnings-driven tech stocks, with Apple's beat as the core catalyst. Second, the energy sector, where Brent crude above $108 directly lifted profit expectations. The weakest sector was basic materials, down nearly 2%, reflecting pessimistic views on global economic growth and industrial demand. Let me explain the three-way dynamic we are watching. The dollar index held at a relatively high level of 98.21, reflecting safe haven demand and interest rate advantages. The 10-year Treasury yield stayed elevated at 4.38%, which normally pressures high valuation stocks. But the tech giants rallied anyway. This is a clear divergence. The logic driving stocks is corporate earnings, while the logic driving bonds and currencies is macro risk and rate expectations. These two narratives are completely different right now. For Asian markets tomorrow, this sends a dual signal. On one hand, the strength in US tech stocks will boost risk appetite for related supply chains like semiconductors and consumer electronics. On the other hand, a strong dollar and high treasury yields will continue to pressure capital flows out of emerging markets. So Asian markets may see a mixed session where tech stocks perform well but the broader market struggles with funding pressure. Let me give you the bottom line. The most important lesson from today is that during earnings season, the earnings and guidance of top companies have become the number one factor for market direction. Macro risks are temporarily being discounted. Looking ahead to tomorrow, focus on sectors that can benefit from the US tech rally, but stay cautious on overall market liquidity. The key word is certainty. Embrace earnings certainty and stay away from the middle ground. That is your takeaway for tonight. Thank you for watching and we will see you tomorrow.